Good evening, students. Welcome to the live coaching classes organized by Board of Studies, ICAI. Today's today's evening, we are going to have a discussion on this topic called valuation under customs law. Examination point of view, this particular topic, valuation, is very important. Minimum 4 marks and maximum 8 marks is a question which you can expect from your examination. All the students who are watching me live, I would recommend don't go for your exam unless you read this one chapter called valuation. For the simple reason, average 6 marks is what you can score out of this particular topic. Now, people are planning for exemption. This is a shortcut. And MCQ, anyway, you have 1 or 2 marks which are covered from your Board of Studies material, and also your examination questions which are given well in advance for your preparatory thing. As a protocol, students who are watching me live, please confirm, am I audible and is my presentation visible? And for your information, this particular material is available on the Board of Studies website, and I would recommend download this Excel file along with the presentation material. Now, let me have quickly some confirmation, students, so that we can go ahead with our discussion. Yeah, thanks for the confirmation, Priya. Now, there are a few questions which were there. Before we start, I'll take those questions and then we'll start with our today's discussion. And students, as I said, please download the material for the Excel file. There are a few problems which we have to practice. I'll take you through previous topic discussion as a recap, and then we'll have today's topic for discussion. There's one question from Mr. Sairam. What is he saying? Sir, is there a necessity to remember the rate of duty for the different products? Examination, Sairam, they'll give you the nature of product, also the applicable basic customs duty, the tariff rate they would be giving. So no need to buy hard, no need to mug up any rate of duty. And there are a few questions for today's evening. Namita is asking this question. So if goods are thrown from aircraft, the goods are landed in India, will customs authority consider it as an import? This is a little tricky question. Sounds funny, but little interesting. First and foremost, it is not that easy. Second, there could be exceptional nature. So Namita is asking this question. Sir, some reason the goods are thrown from aircraft and those goods land into India. Those goods, Namita, we have to see. Is it covered under Section 21? Is it a float SAM, jet SAM? Now, jet SAM is a scenario where I throw the goods out of the aircraft or the particular vessel for the purpose of avoiding the sinking kind of thing. So if that is the case, we would say these are the goods which are covered under Section 21. And under Section 21, intentionally, if the goods are brought into India, then it's called import. The goods which have come on its own because of your act of jet SAM kind of thing, it's not import. Rather, they consider it as a duty-free goods which have come into India. So this question you have to read in this manner, Namita. If it is a float SAM and without intentional bringing those goods, it will not be an import. It's a free kind of permission. If I carry those goods into India, then it is called as an import into India. Relevant duty has to be paid. Second question, Namita is asking, sir, in Section 20, where there is a concessional rate of duty for EPCG scheme, as full amount duty is chargeable, so how it can be concession? Okay. For this particular question, I would like to draw to the respective page of institute material. Yeah. Students, you can come to page number 1.13 of your institute material, where under notification 45 of 2017, when the goods are imported into India, that is export and re-import. Now, in this case, Namita is asking about EPCG scheme. So here, Namita, goods have been imported for capital goods for under APCG license. Goods have been exported and again it has come back. So this particular provision says goods which have returned back to India, the concerned importer has to pay the IGST along with cess applicable on that. They are not demanded the duty concerned. Look at the page number 1.13. In case of point number 4, amount of IGST and compensations is leviable at the time of place of importation of goods. So here, only the respective IGST along with cess is being demanded. They're not demanding the customs duty. So this is the concession which is given, Namita. Then what is the logic for not giving concession in page number 1.14? Page number 1.14, they are giving see, first time you have imported. Now, look at this way, Namita. I declare myself as a EOU. I import the material claiming that I'm a EOU. I export after certain point in time, I get back the same goods. Now, what is the benefit India is getting? Is there any foreign exchange happening? No. Is the goods residing outside India? No. Is the economy getting enlarged? No. So those cases where goods have been exported and those goods have come back, initially when there was the exemption, that is what they have been curtailing. And those goods should have been moving into domestic tariff area. Now, when there is no person who is carrying those goods, there is no, if it is by way of floats and Namita, there is no levy of duty on those particular goods. So with this, let's start with our today's discussion. And as a routine, I have kept few questions for you for a recap from the previous topic. In the last session, we had discussion on this topic called various types of duty. Along with various types of duty, we also had a discussion on exemption, how an exemption notification is issued, and why whether someone can challenge that particular exemption notification. At the fag end of our discussion, we have run through the classification. We have understood first schedule, second schedule, right? So this is a topic what we have discussed in the last class. So what we will do, today's class, we will have a quick recap of some of the topics. So first question for today. First question for today. There's a small typographical mistake. What do you understand with the term TRQ? Explain its relevance and its importance. What is the term? What do you understand by the term TRQ? And what is the importance of this term called TRQ? Examination, please expect 4 marks theory question on TRQ. Tariff rate quota. Now, do you, any idea where do we apply tariff rate quota? What are the circumstances prevailing for application of TRQ? Now, continuation to your question, Namita. If the officer, proper officer was given a due explanation, sir, it is not my act of importing the material, then there is no duty. Just understand that way. The goods have come. I've just, no, I haven't done anything. The goods are laying over there. I went for fishing. I got something. I just picked them. Now, this is how you have to establish. And generally, the goods which are available in the coastal area, it becomes the property of the government, right? In case of your hidden treasury and all. So generally, these are the goods which are in the custody of the government, in the interest of government of India. So with respect to TRQ, what are the conditions prevailing? What are the circumstances under which a tariff rate quota will be applied? Tariff rate quota. Examination, please wait and watch for one question. Now, come to your page number 2.11 of your institute material. Everyone, please come to your page number 2.11 of your institute material. In page number 2.11, you can see power of central government to apply safeguard measures. So whenever there is a glut of cheap goods which are getting into India, whenever there is a dumping which is happening of the dead cheap material, and the government of India decides that they have to protect the interest, right? So in that particular scenario, government comes across for levying safeguard duty. Look at your page number 2.11. Page number 2.11. End of at the fag end of 2.11. What are the measures for? What are the safeguard measures? So when there is a glut of the cheap products which are coming into India, then the government may levy, first measure, imposition of a safeguard duty. Second measure, what is that? They impose something called tariff rate quota. They impose something called tariff rate quota. In the previous class, we had this discussion where Sairam asked this question. So developing countries, when the goods are imported from developing countries, how do we look at this 3%? How do we look at 9%? So when we go for tariff rate quota, implementation of TRQ. So when I say TRQ, there is a restriction. How much of material can be imported from a particular nation? So we decide on the basis of general norms. We also discussed norms regulated as per World Trade Organization. So what is that? 3% of the value of goods from a specific developing nation. And overall, these goods are being dumped into India, not from one nation, maybe from multiple nations. Then I can fix the capping of 9% of the total value imports of the specific article for multiple nations. With a rider, each nation to maintain 3% TRQ. So here what happens? Whenever there is a immediate sudden imports into India of a particular article, and the government of India feels that they should come with some safety measures in order to protect the industry, then the government may impose something called safeguard duty. So imposition of safeguard duty, say SFG duty, or fixing TRQ, tariff rate quota. So this is a modus operandi what government of India has got, right? This is your first question. Let's move on to further. Second question. Second question. Whether CVD, countervailing duty, and anti-dumping duty can be levied for meeting the same objective of protecting the interest of a particular industry. Explain the relevant provisions. Remember, examination have said expect one question from this particular point of testing. Especially when the type of duty is being tested, there's one question which you can expect from this particular topic. So question is whether CVD and ADD, countervailing duty and anti-dumping duty, can be levied for meeting the same objective of protecting interest of a particular industry. Yes or no? If you say no, why is it so? Why is it so? Jairam gives an answer. Sir, it is not possible to levy. Okay, Jairam. Others? I think you have not done a recap after the previous class discussion. At least glance through the topics for the DEMA. Once the class is over, I recommend please have a quick glance through. So for this point number, question number 2, there's a provision under section 9B where they are protecting. The government cannot impose countervailing duty and anti-dumping duty for the same objective. Come to page number 2.24. Page number 2.24. No levy under section 9, which deals with your CVD. 9A, that is with anti-dumping duty. So the government cannot impose levy of CVD and anti-dumping duty under same particular objective. So answer would be as per provisions of section 9B, levy of CVD and ADD is not permissible. You can refer to your page number 2.24 and page number 2.25. Illustration 3 of page number 2.25 gives this particular clarity. Again and again, students, I'm repeating this point. Examination, the questions, few questions are straight away picked up from your institute material. Look at your June 2021 attempt. At least you can see 2 questions which are straight away from your Board of Studies ICAI material. So this is one provision where they say my CVD and ADD cannot be imposed for the same objective. Next. Yes, Naveen. I got the answer from Priya, Sumit, and Naveen. Yes, all 3 of you are right. Let's move on to the third question. Third question. Protective duty is levied to protect the interest of SEZ and EOU. Protective duty is levied to protect the interest of SEZ and EOU. Examine the statement with relevant provisions. So what do you say? Is the protective duty levied to protect the interest of a SEZ unit and EOU? Yes or no? Yes or no? Jairam says no. Selvaraj says no. Okay. Naveen also says no. Perfectly correct. So, protective duty. The objective of protective duty is as per recommendation made by Tariff Commission. Now, this is a particular mechanism where a recommendation is given to increase the rate of duty. They recommend that, look, there is a particular industry where you have not been encashing your revenue. The government of India is losing out its revenue. So this particular protective duty is not on account of protecting SEZ or EOU. Refer to page number 2.8. Page number 2.8 of your institute material. This protective duty are of 2 kinds. One is revenue duty. Second is your protective duty. Revenue duty is for the purpose of raising customs revenue, right? So this particular case, neither SEZ nor EOU has an interest of raising this particular duty called protective duty. Perfect. I could see Priya, Naveen also given the same answer. Good. Let's move on to the last question. Question number 4. Mrs. XYZ Limited, SEZ unit have not paid duty levied under Section 8B. They are not paid duty under Section 8B, mentioning that safeguard measures are not applicable to SEZ unit. Examine the relevant provisions. So there is a company called XYZ Limited. They have not paid the safeguard duty. Now, can a SEZ unit say that this safeguard duty is applicable only for domestic units, not for a SEZ, not for a EOU? Can they claim so? Yes or no? Yes or no? Can a SEZ unit say that, sir, we are a SEZ unit? For us, this safeguard duty, protective duty kind of duties are not applicable. Having said that, can the SEZ unit do whatever they feel so in terms of getting this glut of cheap goods into SEZ location and then migrate to domestic tariff area. Shriram says, no, not possible. Okay. Good. Look at your page number 2 point. Yeah. Look at your page number 2.13, students. Page 2.13 of Institute material. By the way, I'm making all these questions as a reference to your Institute material for the reason you can get adapted to looking at these points, and these are the questions which are tested in your examination. Always I mention this. Every mark is important in your examination. Please keep in back of your memory. Ask the student who scored 39, for whom what is the value of 1 mark. Ask that student who scored 49, who missed aggregate by 1 mark. Ask that particular student who scored 59, who lost his exemption by 1 mark. So don't leave a room for yourself to lose that 1 mark in your examination, right? So coming back to this particular point, with respect to safeguard duty, come to page number 2.13. Page number 2.13, there is a mention at clause C. Imports by 100% EOU or units in SEZ. Safeguard measures shall not apply to articles imported by 100% EOU or SEZ unless specifically made applicable, or articles imported are cleared as such into DTA. So here you will mention unless a notification is made exclusively applicable, or if goods from SEZ are cleared as such to DTA, then a SEZ unit need not pay safeguard duty. This is how you will answer. So here important point is, government feels that the goods which are imported into India, these goods will be used by a SEZ unit for the purpose of manufacture or processing, and these goods travel out of India. So government also feels, though the goods have come in bulk numbers, the goods which have come into SEZ are likely to go back out of India. So it doesn't cause any damage. Now, only when a specific notification has been mentioned that this particular duty, irrespective of a SEZ unit, they have to pay, then yes, answer is correct. Right? Okay. I again got 2 answers. Naveen has mentioned action of XYZ is correct, subject to reference to this particular notification, Naveen. And Sumit says, sir, I got 55 in last attempt. No worries, ma'am. Give little more better efforts, where you see that all the problems in your institute material are duly attended for. One particular secret, I would say, like focus on the examples given in your institute material. Look at your recent amendments. ICAI comes with a material which is relevant. Let me just show you one particular amendment. See, institute always comes with this particular sort of material. Hope you're able to see my screen. See, this is a material which is published by ICAI Board of Studies. So they come with the recent updates applicable for the respective examination. I would recommend go through all these amendments. Reason, from these amendments, at least 2 provisions will be tested in your examination. This is another way how you score your examination, right? Now, let's come back to our topic for today's discussion. I would say a strategy is required to get through your examination. Mere smartness or luck alone is not sufficient. You should have a hard work with a smart work. Hard work, you read all the provisions. Smart work, where I have to focus more. That is what important to us, right? So let's start with our today's discussion. Today's topic, we are going to discuss on the important terms relevant for our valuation and what are the factors which influence my valuation. Valuation methods applicable for imports and exports. In the process of this valuation methods, I take you through a couple of practical examples for you to solve this particular problem. Remember, this particular topic is compulsory from your examination point of view. As I say, 4 to 8 marks is a scope of coverage. Now, to start with, there's a topic called bill of lading. Bill of lading is a particular negotiable instrument, or it's a document where this particular document will consist of some information where it shows or it indicates what is the port of shipment from where the origination is happening, number of packages, identification marks, name of the vessel in which these goods are being dispatched, name of the consignee to whom these goods are going to destined for, whether freight is payable or it is to be paid at the destination. So as I say, it is a document which is a negotiable document which is surrendered to the carrier for getting the delivery of goods. So here what happens whenever this consignment comes from a particular nation, the bill of lading given at a particular nation, that will be given to the CHA for getting the consignment clear. So bill of lading is a technical document which is called a negotiable instrument, on the basis of which the goods will be handed over to the carrier of the agent. Next, delivery order. This delivery order is backed up with your bill of lading. This delivery order is an instruction. This is an instruction, I would say authorization, given by the local agent of the carrier. Now, who is a carrier? I could have Indian Jet Airways. No, Jet Airways is not there. You can have Singapore Airlines. Singapore Airlines is a carrier. So this particular carrier will have a particular procedure where the goods which are carried on that particular aircraft, once they land to the destination, the concerned local agent who gets the position of that bill of lading, based on that, this particular agent who is representing carrier, on the basis of surrendering of this bill of lading or air consignment note. These two documents are nothing but your negotiable instruments. Means a person who is carrying this particular documents will give these documents to the agent of the carrier. Like Singapore Airlines. Singapore Airlines don't have an office in India. What they do, they appoint a local agent for the purpose of collecting the goods for the purpose of transportation or distribution of those goods once they come from the origination. So this particular mechanism, where there is a direction given to a custodian of the cargo to deliver the consignments to the importer. So this particular delivery order is clearly instruction given to a person who is carrying the bill of lading or air consignment note. These two documents have a negotiable instrument characteristics. Now, boat charges, lighterage charges. Now, this is again examination. 1 mark will be tested from a lengthy question. You have a lengthy question where 4 or 5 adjustments will be there. One of that adjustments is on the basis of this boat or lighterage charges. At times, it so happens that the vessel is big. Vessel cannot come into the shores of this customs area because of the size of the vessel, or the vessel has to be stopped because it cannot move from there. They have to put into smaller particular boats, or a consignment which needs to be unloaded is very tiny, where coming to the particular customs area and going back is a time consuming thing. Those cases, this particular boat charges or lighter charges are applicable. Sometimes where vessel is unable to get a berth alongside the queue in the harbor, So like whenever the goods come through your boat, one, the boat is too big that it cannot get a big. Second, this particular in charge of the captain of the boat feels that the consignment which needs to be unloaded is very tiny. Let me not do that particular thing, taking this particular bigger boat to the bay. Rather, I'll just use the smaller boats to carry that consignment from the bigger boat to the customs area. The goods are then transported from the ship to a shore by boats or lighters. These are the small boats. The charges paid for thereafter, therefore, are called boat or lighterage charges. So this is as good as, like, say, there's a consignment which has to come from Japan. So this is your Indian territorial waters. So this particular boat has reached here, and assuming that this is my customs area. So the freight charges paid from the source of manufacturer. So my manufacturer is in Japan. So I pay the freight charges from here to this particular location, and from here, from a bigger boat to the customs area, I use something called this particular boat or lighter. So this additional freight, this is called additional freight. Now, who has to pay this additional freight? This on the basis of norms of supply, either the importer in India or the manufacturer outside India would be paying these charges. Examination, like just keep in mind, this boat or light charges is tested for 1 mark. So this is an additional freight charges. Now, let's start with our valuation. So why is it important to study this topic called valuation? What would be impact if we don't have a knowledge on this valuation? I'll give the answer this way. In customs law, under customs, if someone has to get the valuation done, there's a special team, there is a professional who generally gets this particular approval for valuation under customs law. And most of the time, if you see, there's a related party transaction. The supplier in foreign nation, the importer in India. So a supplier who's there in a foreign nation and the importer in India, if they have a relation, how the relation, there is a small definition. I'll come in another 10 minutes down the line to understand, to make you understand what is a related party transaction. So here, whenever there is a transaction between related party, the value which was offered as per the invoice given by the supplier may be accepted, may not be accepted. So if the value is not accepted, I have to go with the valuation rules to convince the officer what is the value for the purpose of customs law. And just to give a hint of this particular knowledge, students, on an average, not less than 2.5 lakhs is the charges which are paid to a professional to get a valuation done from a customs officer. That is the kind of work involved, professional value from this particular chapter called valuation. And I would say, without no pain, no gain. If you really feel that you can make a career out of this particular topic, wait and watch for another 2.5 hours, whether you can make something out of the valuation. Reason, you have to understand various aspects. Where there is a possibility to set aside the value for avoiding the duties and taxes. Now, some connection with this particular customs law with your income tax, with your GST law. Connection from customs law is when the goods have been imported. So the goods which have been imported is worth, say, 100 rupees. Instead of, like, if I offer 100 rupees, on 100 I have to pay basic customs duty. So I don't offer 100 rupees, rather I offer only 80 rupees. Why is that you're doing? I'm saving my customs duty on that 20%. I'm saving my customs duty on that 20%. Now, this is one classic landmark judgment we had in case of Ford India. When Ford, for the first time they have entered into India, Ford, when they have entered into India, the main competitor for Ford was Maruti. When you imagine Ford, when you imagine Maruti, the cost of Maruti car is worth say 1 lakh. The cost of Ford Fiat may cost you around say 1.5 lakh or say 2 lakhs. If you ask, which car would you buy? People who are having value for money, they prefer Maruti for the simple reason maintenance of Maruti brand car is very, very easy compared to this particular Ford car. Those days, I'm talking 20 years back, 25 years back. So this particular case, it so happened that the goods which have been imported, the Ford has imported the goods in a CKD condition, not a assembled car. So what they have done, the engine has come, chassis have come, the wheels have come. And while clearing the material, they said that this is the engine parts, it is a chassis, and it is not a motor vehicle. And for motor vehicle, the cost, the customs duty is much, much higher, right? So this particular case, the assessing officer said, look, Ford, though you have imported this particular parts in a disassembled form, if you assemble, the main product is going to be a motor vehicle. So I have to classify this under motor vehicle for the purpose of levying the regular rate of duty, which is equivalent to a motor vehicle, not for the spare parts. This was challenged, and the Supreme Court also has come with a beautiful analysis saying that for the purpose of protecting the duty, you have brought those goods under disassembled form. So, point number 1, I'm going to save on duty. Now, income tax also has been thinking through how to tap this particular revenue which is getting escaped. So for a moment, I don't pay customs duty. Now, the rest of 20%, how do I pay? I pay by way of royalty back to the parent company. So therefore, let me recover something called TDS under income tax laws. Let me recover the equivalent GST portion on that particular import of services. So the laws have evolved over a period of time to capture this particular loophole in terms of value which is being imported. And take it from me, the knowledge of the customs officers is enormous in terms of understanding the business, understanding the purpose of this material. Goods which have come into India from a particular related party, they try to understand, has it received in raw material form? Was it received in semi-finished goods form? Is it in a finished goods form? Now, based on the nature of my composition, what should be the rate of duty? What should be the classification? This is how the analysis will be done. So what if I don't do? Then the officer will set aside this particular valuation and they determine the value on their own, something called residual value method. Now, there is a particular term called SVB. I don't know how many of you have heard this particular term, SVB, Special Valuation Bench. Now, this is as per Rule 2, where whenever there is a related party transaction, all those related party transactions have to get a approval from this particular bench to say that the value what I'm adopting is a transaction value and not otherwise. Clear? So this is the second reason. So when I look from your career point of view, from your industry perspective, once you get into the industry, it is very important for you to understand when the particular SSC manufacturing entity is importing some material, is it from a related party or non-related party transaction? And most of you have done your statutory audit. You would have seen this particular case where in the process of your statutory audit, your raw material imported and the raw material which is procured domestically, 80 to 85% of the material is always imported from the parent company, or the rest 15 to 20% which is procured domestically. Even those materials will be from related party transaction. Why do they do that? To pay back this money to the parent company in one or the other form. And do you think that the material is not competitive in India? They have their own policy. When an entity gets incorporated from having the route from, say, China, Taiwan, Japan, Indonesia, they always protect their interest, saying that this particular raw material should have been imported from their nation itself. So this is the purpose way the valuation is examined to say whether there is an influence on my value. So I use a term called influence. Using the influence, the value has been substantially reduced. So was there a barter system? What is that barter system? I give you tire, you give me the electric bulb. So I give the tire, tube or rubber products. You give me the lamp, the electric bulb, or the bulb which is to be fit into motor vehicle. So it's a kind of barter system. I'll give it to you, say the tire which is costing 5,000, they give it at 4,500 or say 4,000. In turn, they say for exchange of that tire, you export certain value of goods. So there is a barter. Consideration is not complete. Consideration was there in kind. So how do I get to know this particular barter system? Again, by way of assessment, how much value of imports are happening, how much value of exports are happening. From the manufacturer who is there in a foreign nation, what is the value of goods imported by importer? In turn, the same importer, what products are exported to this particular manufacturer in a foreign nation. So this particular parameters are examined by the customs officer to understand, was there a prevalence, was there an existence where both the parties to a transaction have got into a mechanism where there is a barter system, or it could so happen. Praveen, I'll assuming that I have a trade connect with some party in Singapore. This particular party in Singapore says, Praveen, look, I'm going to send you this semi-finished rubber tiles. Like what happens? The rubber, it will be heated at a particular temperature. They add chemicals to that and a rubber compound is made. This rubber compound is imported into India. I just cut that rubber compound to make some belts. And those belts, again, I send back to Singapore. Now, why is that they have been doing that? I have a cheap labor in India, or labor very economical. I have machinery which is purchased on the basis of incentive given by Government of India. So when I set up an industry, there's a norm that I get some sort of incentives from the local state government or central government. So I've set up a plan for giving employment. Now I get the semi-finished goods, again I send it back. Now this is where again the customs officer is going to evaluate, was there an influence between you to say that you import some in semi-finished process. Again, the commodity is going back to the same party after processing. In this process, was there any compromise on the value? Next, on the basis of commercial terms, like free on board, FAS, CAF. Let me just come to the respective page. Yeah. Look at your page number 4.7. I have not brought separately. Look at your page number 4.7. Examination, expect one MCQ from this particular terms used in commercial international trade. It's called INCO, INCO, INCO terms. So these are the terms used in your import and export related transactions. So they have used something called X factory, the rate prevailing at the factory gate of the supplier. FAS. FAS is the cost which the export goods are delivered alongside of the ship, ready for shipment. It excludes X factory plus local freight plus local taxes. It includes X factory plus local freight plus local taxes. So from the factory to the port of export, whatever freight is there, and the local taxes. FOB, free on board. So from there, one step further is your FOB. What does it say? Technically, there is no much difference between FAS and FOB. FOB means the stage at which the goods are placed on board, that is conveyance carrying the vessel. It can be said that FAS plus loading charges plus export duty. So here, the loading and unloading. The loading charges at the port is added to FAS to get converted that FAS into FOB. This is one particular term. So examination, MCQ, expect one question for, they will give you FAS or they'll give you FOB. They'll give you various charges, X factory plus local transport plus loading charges is called FA. is termed as FAS. You will say no. Reason? FOB includes your loading charges. FAS does not include your loading charges. Next, CIF, cost insurance freight. That is your FOB value. My CIF is simple terms. Whatever FOB is there, to this FOB, I add something called insurance and freight. Now, freight from where? From the port of consignment, the exporting nation, till the place of importation, and also respective insurance. If I add these three, I get something called CIF. So here, the customs officer would like to know, was the material reaching the place of importation on CIF, FOB? On the basis of this, some addition, some deletion will be done for the purpose of determining my value. Obligations of supplier duly met by the importer. Now, there could be a scenario where, let us take this example. Say, Priya, who happens to be a manufacturer in Singapore. Naveen, who happens to be an importer in Kerala. Now, Naveen wants to import some consignment from Singapore. Now, Priya is a person who does the manufacturing activity. Part of that particular manufacture, the goods have to be sent for some specific job work, requirement of Naveen. Naveen says, sir, the machinery which you are manufacturing, there should be some sort of logo embossed. There should be some sort of light emulsion where my company logo will be displayed with the LED backlight. So Priya says, I don't have that facility. Naveen says, don't worry, ma'am, I have one known job worker. That particular work will be done by so-and-so party. Now, the value which was done by that job worker in Singapore was met by Naveen on behalf of Priya. Assuming that this is in the scope of Priya, Naveen has paid for that job work. Now here, the obligation of Priya to pay to the job worker, Naveen has paid directly. So here, the customs officer is going to question, should I accept this value or is there any addition? Now, this is how, based on your business equation, the customs officer is going to question, should I accept this value or should I challenge this particular value? Now, section 14 is the origin of entire valuation, where my customs law says that a value to be paid for the purpose of customs duty as per section 14 of Customs Act, read with rate, that is section 2 of Customs Tariff Act. My Customs Tariff Act gives the rate of duty, and section 14 of Customs Act gives me the transaction value. So they say that the value of imported goods or exported goods shall be transaction value, that is to say, price actually paid or payable. Now, money paid or money to be paid. Now, we have various documents called LC, letter of credit, or another mode of negotiable instruments. So these are other mechanisms where money was paid or money to be paid. For the goods, when sold for export to India, for delivery at the time of place of importation. So when the goods are imported, at the time of importation, whatever money you have paid or money to be paid, payable, that will be considered as my transaction value. From or for export from India for delivery at the place of exportation. So there is a place from where I export, that is happening from India. So at this place, the money, what I'm going to receive, if money is received or receivable, this will be considered as my transaction value. So section 14 very simply it says that, look, whenever there is a transaction, I go with transaction value. What is the transaction value? Money paid or payable. How? At the place of exportation or at the place of importation. So this is, in simple terms, covered under section 14. Now, they go one step further. Further, what do they say? When I'm going with transaction value, I presume that buyer and seller are not related. And price is the sole consideration. That means there is no barter. There is no exchange. There is no other way this consideration has been paid. Subject to such other conditions specified in the rules. Now, in addition to these points, they say, I have prescribed some rules. You comply with these rules. This is what my Section 14 under Customs Act talks about valuation. That is your transaction value. So please make a note in your running notes. My transaction value is the value for, that is money paid or payable for the goods imported or goods exported at the time of importation or from the phase of exportation between a buyer and seller who are not related. And price is a sole consideration. Now, this one definition gives the entire clarity. What is the value on which I pay customs duty? Next, they say when you're doing so, this particular transaction value, whatever you're saying called transaction value, in case of imported goods, shall include. So this transaction value, whatever you are declaring, please ensure that it has got few inclusions. What is that? Amount paid or payable for the cost or services. Like example, I said Naveen who is there in India and Priya who is there in Singapore. So Naveen asked Priya, please get this job work done from any of other job worker in Singapore. What money Priya is supposed to pay to job worker, Naveen has paid directly to the job worker. The obligation of Priya to pay to this job worker, instead of Priya making the payment, Naveen is directly making the payment of this money. Why? Naveen believes that when the goods come into India, I can save the job work value. When I save that, I can save the customs duty because basic customs duty is a cost to my worksheet. When I prepare a cost sheet, my prime cost, when I prepare a cost sheet, my prime cost, this is one area where the competition plays a role in terms of supplies to OEM. When I talk this particular topic, all of you, please look from this particular angle. Whenever there is a manufacturer who supplies goods to OEM, original equipment manufacturer, how can the price be made competitive? To make the price competitive, always your prime cost in your cost sheet. This plays a prominent role in terms of getting an edge over your competitor. Now, why I'm telling you this? Post-qualification, once you get into industry, where you happen to be the CFO or the operational head, at that point in time, you have to review your cost sheet. Is there a scope where we can reduce the cost? So these are the goods which are imported. What is the dependency on imports? What is the dependency on my domestic units? So if there is a predominant value on which I'm paying my customs duty, is there a way the customs duty can be saved? I'm not saying tax evasion. I'm saying a tax planning. So this particular prime cost plays a decent role in terms of determining your cost. So they say this particular money, what you are importing, which is called transaction value, should include something called amount paid or payable for the cost of services. Second example. Say Priya manufactures the goods and the goods are ready for dispatch in Singapore. The goods are ready for dispatch in Singapore. Now, part of the process, the goods have to be tested. Why is it required? If the goods come into India and assuming that there is some malfunction, again I have to send it back to Singapore, again I have to get after some point in time. To avoid all these particular issues, there's something called testing. So there should be a proper testing done for that particular goods to be dispatched. Now, these testing charges, whatever testing charges are incurred by this manufacturer should also be forming part of my FOB value or your transaction value. This is your first inclusion. Second inclusion, what they say, include commission, include brokerage, include engineering, design work, royalty, license fee. They have just given indication. Commission and brokerage. I don't know how many of you have dealt with this individual sales and marketing representatives. I call them as marketing head. There will be few people who will be called as a national head sales to Singapore, Asia Pacific, national head sales to this particular zone. Now, these are the people, what they do, they connect two people. They connect two people. There is one seller in US, there is one buyer in India. There is one seller in Singapore, there is one buyer in India. There is one seller in India, there is one buyer in Bhutan. So these people connect this the seller and buyer. For doing so, they get something called commission brokerage. So if there is any commission brokerage incurred for the purpose of procurement, that needs to be added to transaction value. Engineering cost, design work, royalty. Now, when I talk about engineering and design, imagine this thing: molds, dies, jigs. Mold, die, jig. Let's take an example. Say I have a spiral binding book. This is a book which has got a spiral here. What if I have some particular laptop which also has got this facility? Now, this is again a design. I have a manufacturer who is manufacturing this particular commodity product in China. The design was developed in India. This design was given as a free of cost for developing the product. When I give a design, along with the design, I need to give supplements called molds, dies, and jigs. How does it go? It goes from a particular party. Now, was this parts where there is an engineering cost? Was this also forming part of my transaction value? Royalty and license fee. Royalty and license fee. Now, this particular royalty and license fee, you have two kinds of royalty. When you are doing your statutory audit, you would have come across this royalty. Now, generally, royalty is paid on the import value or on the basis of production and subsequent sale. So there could be two kinds. One, I import and I do trading activity. Whatever sales I have done, I pay royalty back to my parent company. Second, sir, I import the raw material, I manufacture, I use in manufacture where there is a technical know-how and I sell, I pay royalty. So again, if there is a royalty on that particular material, please include back to your transaction value. Cost of transportation to the place of importation. My transport cost till the place of importation. Insurance, loading, unloading, handling charges to the extent the manner specified. Now, these are all various costs they say should be added. Now, please pay attention here. I have transaction value. To that transaction value, I'm paying some cost of services. I'm also paying something in relation to brokerage or commission directly connected with the purchase in relation to design or royalty. I'm also paying something called transportation and insurance, loading, unloading, and handling till this place of importation. Right? This all add together. I call that as cost, insurance, freight. CIF. I derive something called CIF. So the value on which I pay customs duty is the transaction value. That is a basic value, FOB. This FOB plus your insurance and transportation. Transportation, insurance. I get something called CAF. So this FOB includes basic value of material, the direct cost associated, indirect cost associated, and also this other elements. All these three put together, I call this as FOB value. Let's come to one example to understand this particular valuation. Example 1. Hope the Excel file is visible, students. Yeah. So I've taken an example called problem number 1, where we will examine under section 14 what is my value. What is my value for the purpose of customs section 14. So they have given some information. What is that information? Value of machinery at factory gate of supplier. value of machinery. This I call as X factory. That is without any charges. Cost of packing material. Now, this cost of packing material is essential, yes or no? This cost of packing material along with the machinery. When I buy machinery, I need to have the packing material. Why? The machinery should reach in a safe condition. The machinery should not have any damage. So for that, cost of packing material is essential. So I call that also as an X factor, means including that particular price. Design charges for the plant in India to be paid by the importer in India. There is something called design charges. Now, look at this column E. E I'm mentioning in foreign currency. The values, what you are seeing over here, those values are in foreign currency. That means to say, I brought these aspects for understanding from import point of view, right? Now, so these design charges are for a plant in India to be paid by the importer. Now, is this connected with my import? Now, it is nothing to do with my import. Once the machinery comes to India, for installing that machinery or for the purpose of assembly, I need to have some design work done in India, in my factory. I'll break a wall. I'll increase the height of my ceiling. I'll change this particular, process from this stage to this stage. So some sort of expenditure incurred in India, nothing to do with that particular commodity. So what I'll say, I'll ignore this for transaction value purpose. Handling charges and transport charges up to the port of exportation. Handling charges and transport charges up to the port of exportation. So if I add to X factor this, I get something called FAS, right? So this to be included. Next, freight charges up to the place of importation. So from the port of exportation, from the port of India. So if I imagine from the original nation, from here till my port in India, the customs station in India, I need to pay transportation, freight charges. This also needs to be included. Purchase commission paid by the importer. Now, commission paid, there is something called Rule 10. Rule 10, which excludes buying commission. So as of now, students, I would recommend assume that this purchase commission is not a buying commission. So I'll say include. I'll give a clarity when we travel to Rule 10. Now, these are the values which they have given, and we have analyzed the importance of these expenses. So what does my section 14 say? Your X factory price and your cost of goods and services associated with that particular goods, your loading charges, your local charges from the factory to the port of export, the transport from the port of export to India, insurance overall. All these are the expenses I have to take into consideration, right? So I'll say value for section 14 of Customs Act 1962. Here we will say I'll add X factory, I'll add packing charges, I'll ignore the design charges, I'll add handling charges and transport charges up to the port of exportation. Again, to this I'll add what is that? Freight charges. Without freight, the commodity cannot reach into India. Again, to this I have to add something called purchase commission. Reason, unless I pay the commission, the supplier is not going to supply the material to me. Now, this 24,960 is US dollar. Now, what they say, when I have to pay my customs duty, I have to convert this particular foreign currency into INR. So when I have to convert, always there is a no rate notified by customs. So value in INR for duty computation. What I will do? This value in foreign currency into 78, which was given to me, I calculate my value of import. So the transaction value over here, students, is 19,46,880. Are we clear with this transaction value and value to be included? Is this clear for everyone? This is the starting point, students. Once you have a clarity on this, the rest all rules are straightforward. You can easily understand these provisions. Namita is asking this question. Sir, if light rate charges are paid when ship is in territorial waters, then it should not be included in CF value. My CF includes transportation till port of importation, Namita. So till the consignment, the goods reach the customs station. I repeat, till the goods reach my customs station, all expenses in relation to transport have to be taken into consideration. So this territorial waters concept, Namita, yes, we have to take into consideration. Next, Namita is asking this question. Sir, if testing charges is incurred as a responsibility of seller, so why it is to be included in FOB value? Now, take this way, Namita. If the material doesn't come with a test certificate, you will not accept the material. Reason, most of these consignments, wherever there's an international transaction, you cannot expect that goods come and go back because of quality issue. Very, very costly affair, time consuming, and also it is going to cost heavily when you delay in supplying to your customer. Most of the cases, Namita, these manufacturers supply the goods to OEM. Now there is something called LD clause, liquidated damages. There is something called LD, liquidated damages. Or there is something called just in time. When the goods are not supplied in just in time fashion, when the goods are not delivered as per the time promised, there will be huge penalty clauses as per the commercial terms. So for that reason, Namita, whenever these testing charges were paid, it forms part of a ingredient. It is the main part of my cost. My FOB should include this test certificate charges. So for that reason, I have to take that into CAF. Hope this is clear, Namita. And students, this value, transaction value, are you clear? What to be included, what not to be included? Is this clear for everyone? If any doubts are there, let me know, I'll clarify. Otherwise, we'll go on to the next topic. Good. So far, so good. Now, let me come back to my presentation. From here. Now, so far, so good. Now, you're saying that when the transaction value is between unrelated party, you're going with transaction value. So what happens if there's a related party transaction? So my Customs Act says that whenever the value circumstances where buyer and seller are deemed to be related. So the customs law has defined. Another 10 minutes down the line, I'm going to show you how this relation comes into existence. This particular case where there is a related party transaction, my rules will explain manner of determination of value. Where if it is a related party transaction, my rules explain how do I admit that value. So what if there is no sale? Like example, there is a trust which is operating blind or visually impaired students. Now there is an organization who adopts this child who doesn't have a vision. Those particular children, they will provide a free education. They also provide a free accommodation. Everything is taken care. So as an NGO, when they are operating, assuming that one organization comes forward and says, look, we'll give you a computer, we will give you a machine where any book, you just need to keep the book like this. I don't know how many of you have seen this. You would have seen there is a table lamp. This table light, when you sit on a table and study, a small light is there next to you to help to have a light on your book. Similar to that, there will be a small lamp kind of thing, like this lamp post. You just keep your book below the lamp. This particular lamp has got a sensor which reads all the contents in your book. Like you just turn the pages. When you turn the pages, all the content which is printed gets recognized in this machine. And the beauty of this machine is it can convert any local language into English. It can convert any local language and it can convert that into audio. So what happens to these kids? The Braille is a book they have. It is not possible to print so many Braille books for all the students. So one of manufacturer comes forward and says, look, I'll donate 10 machines for your trust. Now there is no sale. The machine which has been imported, it has come through customs. Now customs, please remember, customs law doesn't look about the person. Customs law looks at the goods. So when this machinery comes to the officer, when there is no value, he'll go back to the valuation rules to determine how to find the value where there is no sale. That means there is no consideration. When there is no consideration, they go back to respective rules to find out what is the value. So whenever there is a related party transaction, again, value says how do I fix the consideration. Or there could be a scenario where price is not the sole consideration. Again, my valuation rules comes into help me to figure out how do I come with the value. So for all these purpose, we have this particular mechanism called SVB. Generally, I go for SVB only in case of my related party transaction. In case of related party transaction, special valuation bench who gives the value adopted for customs. There could be a process where rules are formulated. The customs officer may accept, the customs officer may reject the value declared. Now, it is a rule where customs officer says, Praveen, you have imported material from Singapore. Priya happens to be the supplier. I see that Priya and Praveen are related. Reason, there is a control of entity of Priya. There is a control of entity of Praveen by another person called, say, Naveen. Naveen is one interested party who is controlling Priya, who is also controlling Praveen. So how do I get to know? When Praveen furnishes their financial statements, all of you remember your consolidation, notes to accounts, related party transactions, where I disclose what is the relationship of Praveen with Naveen. Similarly, when the officer draws the financial statements of Priya, Priya also shows that she has got a related party transactions with Naveen. Looking at the financial statements furnished by Priya, by Praveen, the customs officer says, look, I suspect that your value is not at arm's length. Again, there's a way to reject that. Now, these are the ways where rules talk about whether the value accepted, whether the value is rejected. Now, there is something called tariff value. Tariff value means I don't go based on CAF. I don't adopt CAF. It is least important for me. So for few commodity, instead of going with CAF, they determine something called CAF. Like example, gold, silver, copper, steel. So there are certain metals where government says, no, I don't want to go with CAF. I myself give something called tariff value. So the day when the metal gets imported, they say, if it is gold per gram, 4,470 is the value I fixed. It's a tariff value. So any imports between 15th September to 14th October, the value of gold happens to be 2,270. So importer just goes to the customs office and says, sir, I have imported gold. Oh, gold, this is the tariff heading. For this, there is a tariff value. So the government decides few items, they don't want to go with CAF value because the metals are very precious in nature, or this particular commodity has so much of value fluctuation. It is not easy to fix CAF. So the government decides that few items I determine the tariff value. Means based on the article, this is the value on which you pay customs duty. This is the purpose of your tariff value. Moving further, rate of exchange conversion rate. Examination, as I say, 6 marks is a weightage. Out of 6 marks, this particular conversion has got a weightage of 1 mark. Out of the lengthy 6 marks, somewhere you do the calculation of CAF value in INR for the purpose of levy of basic customs duty. That point in time, I adopt this rate of exchange. So my provisions say that when the goods are imported, when the goods are exported, the money, the value is in foreign currency. So with respect to this rate of exchange, where the goods are in foreign currency, in case of imports, the day when bill of entry is presented, that day, whatever is the rate that I adopt for imports. So what happens to exports? In exports, I have something called shipping bill. The day my exports, that is shipping bill, is filed, the rate prevailing on that day where shipping bill is filed under section 50, that will be the conversion rate. I draw your attention once again. In case of imports, bill of entry is relevant. In case of exports, shipping bill is relevant. I don't know how many of you have seen this particular aspect when you're doing your audit. Goods exported out of India. Goods exported out of India for export purpose. So the value of consignment is $100,500. When the goods exported value is $1,500, should this conversion done at RBI rate? Should it be done at customs rate? Should it be done at banker, that is authorized dealer, the agents who does the conversion? RBI gives a standard rate for the day. Customs gives a rate for a particular period of 30 days. Authorized dealer, whenever money is sold, whenever money is purchased. Now, when I have 3 choices, what is the rate I have to adopt for accounting? Most of you have done your statutory audit. Please give me your answer. In relation to exports, when an exporter has 3 choices, one is RBI rate, second is customs rate, third is authorized dealer, that is the person who sells the foreign currency. What rate you will adopt for the purpose of conversion? Please give your answer. Please give your answer. Shivraj says RBI rate, okay. Sham says again RBI rate. Surprise, okay. Okay, I could see only 2 answers, Shivraj and Sham. Now, please understand, students, in case of your exports, always my rate to be adopted is customs rate. I have to adopt customs rate, not RBI rate, not your authorized dealer rate. Again, my valuation rules under GST law, Rule 33 says value to be adopted for the purpose of import and export. In case of goods, my conversion should be done as per customs rate. So this is what you need to understand. Now, let us look at one problem. How do we adopt this customs rate? Again, examination. Please wait and watch for 1 mark on this adjustment. So let's come to problem number 2. Application of rate of exchange. Goods are imported by XYZ Private Limited. Goods are imported by XYZ Private Limited for $24,560. Compute the value in INR. The date of entry of the vessel is on 12th August 2021, where the exchange rate happens to be 72 rupees per dollar. Date of filing of bill of entry under section 46 is on 15th September 2021, where my exchange rate happens to be 70. So in this case, students, will I adopt my date of entry 72 or will I adopt 70? What would be your answer? What would be your answer? What would be your answer? this 24,560, which is there in dollars. $24,560. What should be the conversion rate? Is it 72 or is it 70? What would be your answer? Kaushini says customs rate, correct. Santosh says RBI. Priya also says RBI. Geeta says customs rate. Students, please correct yourself. This should be a customs rate. And Priya says I have to adopt it 70 rupees. Why file of bill of entry filed on 70? So the answer is 70. So my INR will be 24,560. 24,560 into 70, the date of filing of my bill of entry. So this is your answer. Examination students, again I'm telling you, please be very, very careful. 1 mark is a weightage. 1 mark is a weightage. Right? So this is for A. Now let's look at point number B. Goods are imported by PQR Limited for Singapore dollar 580. Compute the value in INR. Date of filing bill of entry is on 24th October 2021. Where my conversion rate 54 rupees per Singapore dollar. Date of entry of the vessel, that is on 2nd November 2021. Where exchange rate is 58 rupees per Singapore dollar. So for clause B, in case of Singapore dollar, my bill of entry happened on 24th October and vessel entered on 2nd November. So should I adopt 54? Should I adopt 58? What would be your answer? What would be your answer? I could see Geeta, Santosh gave 70, all three of your rate mark. And again, Priya says I have to adopt 54. So here, again, importance is on the date of filing of bill of entry. So my conversion rate should be 54. Conversion rate should be 54. So going as per 54, 580 Singapore dollars into 54 rupees per Singapore dollar. 31,320 happens to be my INR. Good. Now let's go back to my valuation. Now, we have, as of today, for imports, 13 rules which have been formulated. Namita, I think there's one question from you. I am not clear with your question, Namita. Please explain the reason why loading. I couldn't understand your point, Namita. If you can elaborate, I can clarify on that point now. Coming back. Valuation rules, we have 13 rules. Examination point of view, not everything is important. Few points from your what you call definitions. One MCQ will be tested for 1 mark. Rule 3, very important. This is the means for subsequent rules. Rule 4, Rule 5, only a problem can be expected. Rule 6, determination of value. That is, it is giving a choice whether to go as per Rule 7 or Rule 8. In fact, Rule 6 is actually nonsense. It should not have been there. Rule 6 says, should they go with Rule 7? Should they go with Rule 8? Like where there is a failure of Rule 3 to 5 means Rule 3, Rule 4, Rule 5 is not giving an answer for value. Then Rule 6 says, you go either with Rule 7 or Rule 8. Now, is it required to say that? Unfortunately, it has been copied from your World Trade Organization fundamentals. Now, Rule 7 talks about deduction value, means you derive it a value. From that value, you reduce few aspects. Then, based on this, you derive something called transaction value. When you don't get the answer from Rule 3, Rule 4, Rule 5, now you go travel to Rule 7, where you pick some value. From that value, eliminate few items, then you get something called transaction value. Rule 8 is a computed value as per your generally accepted accounting principles. This Rule 8 is very tough to calculate. No, practically, it takes away life of the accountant. Rule 8, residual value. Again, very rare the officer resorts to apply this rule 9. Rule 10, very important. Examination, you get at least 4 marks on the basis of adjustments in rule 10. Now, when I'm talking about these rules, students, please keep an eye on these rules. For the reason, your examination questions are based on these rules. One is rule 3, second is rule 10. Now, overall, these are the only 2 rules which gives a guidance what to be done. Then, rule 11, it is a simple declaration. Like now, I declare, like when you file your GSTR 1, when you file your GSTR 3B, there is a small declaration. Now, before your tick check box, you just click the check box, then your submit return gets enabled. You click on the checkbox, then your file return gets enabled. I declare that the values declared above are true and fair to the best of my knowledge. I understand that anything wrong, any non-violation in this regard, any value done intentionally to avoid payment of tax, I will be responsible for the information furnished. That's how I give a declaration. Rule 12, where the officer gives a rejection, he does not admit with any of the above rules which are given. And rule 13, this is like a indication. It is a note. It's a notes. This rule 13 gives me information for each particular rule, how the practices are there in World Trade Organization, given as a Bible or indicator factors for applying these rules. My principles of above 12 rules are on the basis of the directions given from World Trade Organization. Now, why we depend on World Trade Organization? Reason is the international trade. Assuming for a moment, goods or consignment comes from Japan, lands in India. Customs officer rejects the value given by the exporter or importer. Then they can question that aspect of Indian customs officer in World Trade Organization, saying that, look, you have given a charter. As per the charter, these are the bylaws in relation to foreign trade. So when there is an international trade happening, you decide how these rules have to be formulated. So by and large, any nation I go, my valuation are in line with my World Trade Organization practices. Few rules here and there is a tweaking done just to accommodate my Indian GAAP, generally accepted accounting principles. So in India, when I prepare my cost sheet, there is a standard called CAS4. What is the importance of CAS4? When there is a transfer of goods from one process to another process, when there is a transfer of material from one stage to another stage between a related party transaction, CAS4 gives me a clarity, what is the percentage margin, what is the profit loading. So when I go for this SVB, special valuation bench, I was talking about the prospects of your customs valuation. This process, this aspects help me to convince the officer concerned over here. Please keep in mind, you are going to get into an industry where there is a manufacture, where the goods are being imported. This SVB is a process where every one of you have to see through for your career prospects. And assuming for a minute you can reduce your value, that is your transaction value, by 0.05%. I'm telling this. If you can reduce your transaction value by 0.05%, this can save few millions to the organization. How it happens? When I save my transaction value by applying the principles of SVB, by understanding these governing principles, there is a reduction of loading. I call this as a loading. Why there is a loading? Why I load the profit margin? Because of related party transaction. The customs officer says that the seller and buyer have agreed upon a price to reduce your customs duty. Once the customs duty reduces, your cost of import is cheap compared to the local manufacturer. Let's take example of Maruti. Maruti Suzuki, Maruti. Maruti procures the material domestically. Maruti Suzuki, on the other hand, imports the material. So the motor vehicle manufactured from imports, motor vehicle manufactured indigenously. Now, this particular importer, if they want to be a competitor, get a price bidding from one of their customer. Now, to have a better edge compared to Maruti, if there is a price hidden in imports, I can be a competitor for my local manufacturer. This competition is avoided by concept of loading applied on SVP. Examination not there for your syllabus. I'm saying that this is tested post your qualification. Coming back, let's start with rule 3. Before that, there is a small example which is important for you to understand. Identification, identical goods. Identical goods means those goods which are same in all respects, including physical characteristics, including quality and reputation, as the goods being valued except for minor differences in appearance. So when the goods are being imported, so what if there is a related party transaction? So they say you compare this value with the identical goods. If the value is matching, then come back to your transaction value. I'll give an example. Let me come to my Excel file. This is only for what you call academic discussion. So there is a laptop imported. Dell make, Lenovo make. Configuration. They say 16 GB RAM, 512 hard disk, Intel 5 processor, i5 processor, Lenovo, say 12 GB RAM, 512 hard disk, and Intel 8 processor. Now, assuming that XYZ Limited, Mrs. XYZ Limited has imported this material. The laptop has been imported for 54,000. And this laptop was imported by Mrs. PQR Limited. Now, for the purpose of this definition, I cannot compare Dell with Lenovo. Reason, both of them have a brand reputation. Now, I cannot say Dell is superior, Lenovo is inferior. Or Lenovo is superior, Dell is inferior. Both of them have their own features. Now, when I compare this laptop with this laptop, hard disk is same. RAM, there is a small difference. Processor, there is a difference. So this will be called as not as identical goods. So this manufacturer XYZ cannot go to officer and say, "Sir, please compare with this," and say this 54,000 is agreeable. Now, for a moment, this particular laptop I have to compare. They're saying that identical goods. Let's take scenario 2. This is a Dell laptop imported by Mrs. PQR Limited. Where it is 16 GB RAM, it is 512 hard disk, processor is i5. The value is say 52,000. Now, What is happening here? This is black color. This is blue color. Now here, I can call this as identical goods. This particular scenario can be called as identical goods. So what is happening here? When XYZ Limited goes to the customs officer says, yeah, you have imported at 54,000. I suspect that this should be at 60,000. Then XYZ Limited can say, by your officer, there is some identical goods, like which is imported by PQR, which is also for Dell make, which is 16 GB RAM, 512 hard disk, ICAI processor. Let's come back to the discussion. Look at this definition. Identical goods means the goods which are same in all respects, including physical characteristics, quality, reputation. When I say reputation, could be of a brand make, as goods being valued except for minor difference in appearance. So in this example, you take black color, blue color. People prefer black color than black color. So that's a minor difference. Not affect the value of goods, and that do not affect the value of the goods. Produced in the country in which the goods are being valued by were produced. So the country, identical goods means goods imported by PQR, goods imported by XYZ, both are from produced in the same country. Produced by the same person, Dell, who produce the goods, or where no such goods are available, goods produced by a different person. Assuming if there is these identical goods are not there in that particular nation, then produced by different person. These goods will be taken into definition called identical goods. Place of importation. It's a customs station where the goods are brought for clearance. Now, Namita, your question comes here, Namita. You're asking about the 12 nautical miles where the freight, the boat charges are paid. Any expenses incurred means the way goods are brought for being cleared for home consumption. My home consumption happens from customs station. So any expenses still this place of importation are relevant for CAF purpose. One question asked by Namita, where any expenses are incurred in the territorial waters. It is in relation to the import. So this place of importation happens to be a customs station where the goods are brought for being cleared for home consumption, right? Or I put into warehouse. So that particular case, my definition of place of import is relevant. Now, similar goods. Similar goods are those goods which although not alike, like example, we took that Dell versus Lenovo, i5 processor with i3 processor. They have same characteristics. Laptop is laptop. Component materials which enable them to perform same function. Performance of a laptop. To be commercially interchangeable means a laptop of Lenovo with laptop of Dell. With the goods being valued, having regard to, they have given some consideration with regard to quality, reputation, existence of a trademark. So Dell has got a different trademark, Lenovo has got a different trademark. It could be called as like what do you call thin note, thick pad, notepad, some sort of brand. So these cases I call them as similar goods. Now these are the two definitions connected with my Rule 4 and Rule 5. This identical goods and similar goods are connected with Rule 4 and Rule 5. So for the purpose, I need to know this particular definition of identical goods and similar goods. Now, let us start with Rule 3. Okay, there is a small definition for related party transaction. Expect one MCQ from this related party. If they are officers or directors of one another business, who are that? Importer and exporter. Person who is from other nation, importer in India, or exporter in India, importer in other nation. If both of them are officers or directors of one another business, they are legally recognized as partners. So if there is a partnership, then again, it's a related party transaction. Employer-employee relationship. related party. Any person directly or indirectly own, control or holds 5% or more of the outstanding stock or shares of both of them. So there should be a third person. A third person is holding more than 5% equity or who is having a control more than 5% in exporter and importer. Again, it can be called as a related party transaction. Expect one MCQ from here. Assuming that Mrs. ABC Private Limited holds 3% of the shares in XYZ Inc. and Mr. P, Mrs. PQ firm. Examine if there is a related party transaction. Now here, to exercise a control, holding a equity, I should have 5% or more, equal to or more than 5%. So this is a test. Examination, they'll give you less than 5%. Then they will say whether there is a related party, yes or no. So to exercise this control, the third party should be having the ownership, that is our control, or who's holding 5% or more of equity. One of them directly or indirectly controls the other. One of them directly or indirectly controls the other. Again, MCQ from examination. ABC Private Limited in India, XYZ Incorporated outside India. XYZ Incorporated holds 30% of shares in ABC Private Limited. Now, can we say there is a control? For having a control, please remember 51% is a requirement. Reason, up to 50%, it's 50-50. I cannot say I have a control. If I have 51%, then I can say I have a control. So if XYZ Inc. holds 51% or above 50%, then XYZ Inc. is in a position to control ABC Limited. So one of them should be holding, having a control. So examination, point number 4, point number 5. Please wait and watch for a MCQ question. Both of them directly or indirectly controlled by a third person. So there is a control by a third person. So this control happens again by way of equity or any other mode. Now together, this importer and exporter together directly or indirectly control a third person. Again, there is existence of a related party transaction. Family members, related party transaction. Persons who are associated as a sole agent or a distributor or a concessionaire, whatever be the way, again, these people will be considered as your related party for the purpose of rule. Now, these are the basic principles for my related party transaction. Let's come to rule number 3, which talks about your value in case of goods. How do I determine the method of valuation? Rule 3 talks about my method of valuation. What it says, subject to rule 12, that is, the officer may reject the value. The value of imported goods shall be the transaction value adjusted with rule 10 towards cost of services. So they say, I go with my transaction value. If officer has not rejected, I will take into consideration my rule 10, where value of cost and services are duly adjusted to transaction value. So this is my rule 3 says. So all transactions, whenever the goods get into India, straight away, blindly, I'll say that, sir, this is my transaction value. How? As per rule 3. Where I'll say, sir, I'm coming forward to you with application of rule 3. I'm saying that this rule 3 is my transaction value along with the adjustments of cost of services under rule 10. So this, they say, price is actually paid or payable. So whenever you're offering transaction value, please ensure that this money is paid or payable. Letter of credit or bank guarantee or advance deposit, whatever it is, money, what you have paid should have been the full consideration. Then, activities undertaken by the buyer on his own account other than Rule 10. Now, like example, construction, erection of a plant and machinery. For an example, for an instance, a machinery is imported from Germany. This machinery, when it comes to the factory in Tamil Nadu, Chennai. So this machinery has to be installed in the factory. So how does the installation happens? I need to have this particular machinery where there is a civil work to be done. Why I do civil work? Not to have a wobbling effect. That wobble effect, where vibration. When the machine operates, it should not have a vibrating effect. So not to have a vibration effect, I do a civil foundation. So along with the civil foundation, this machinery needs to have a power. There should be an uninterrupted power supply. So what I do a electric cabling work. So any work, any value which you spend on that machinery, who is spending that? Importer, should not be taken into consideration. So this money paid or payable does not require the value of this activity done by the buyer in India. Sir, not only that, I pay something called entry tax. I pay something called customs duty. I pay something called anti-dumping duty. Any taxes, any duties you pay in India are not disturbing your transaction value. This is the first interpretation of my Rule 3. So they say, I go with my transaction value where money is paid or payable. It does not, it includes all adjustments as per Rule 10. It does not include the income, the expenditure incurred in India in relation to those goods. This is the starting point of my Rule 3. Now, Rule 3 says that, look, when you have brought the goods into India, is there a condition? For me to accept your value, are there any restrictions towards disposition, that is sale or use? Is the seller or manufacturer imposing any restriction? My Rule 3 is asking this question. Look, you have come to me, you have declared your value. The value what you've declared, should I accept the value? For that, for the goods to be used, are there any restriction other than the restriction imposed by law or public authority in India? Example, goods which are imported into India during COVID time, they say, you isolate this consignment for 14 days. Now it is a norm. Any chemical which is imported into India, a sample should be sent to a laboratory, get the test certificate. Only when this test certificate is given by the concerned laboratory, then you use in your manufacture. Now, what is happening here? There are rules and bylaws which are imposed by the authority of the land or the authorities of that soil. So if this is a condition, I don't have an objection. Second, this restriction is by way of a limit of geographical area in which the goods may be resold. Now, many cases we would have seen that, in case of your goods which are being imported into India, assuming this is a map of India, don't take it otherwise. Just imagine this is India. And assuming that you have neighboring countries over here. Now, assuming that you import goods from a particular nation over here called USA. Now, there is a condition. Look, any goods which are coming to India directly, you should not sell to neighboring countries. You should not sell to these neighboring countries. Why? I sell to the neighboring countries directly. Now, this is a geographical condition. Again, my Rule 3 says, yes, I admit. Because of world trade, your international trade practice, if there is a condition that the goods should be used in India, I do permit. There is no rejection of your value. Third, there is no substantially affect the value of goods. This restriction do not affect the value of goods, substantially affect the value of goods. Example, there is a product launch. Now, you have this Vivo or you have this MI. This is a product launch. They say, look, I'm giving the goods where we are doing an advertisement. First, the main manufacturer comes with advertisement across the globe. They try to push this product into the market. Then it should be made available for sale. So if this is not going to have a substantial effect of the value, if this is of that condition, then I'm going to accept your transaction value. So what they say, look, you're coming to me. The seller has given a restriction. Those restrictions are of this nature. I agree for your transaction value. So your this condition says that manufacturer has imposed the conditions. Next. Rule 3 further says, the sale or price is not subject to some condition or consideration for which a value cannot be determined in respect of goods being valued. The price is not subject to condition or consideration for which a value cannot be determined. Now, what happens? The seller says to the importer, look, I sell 10 tons of product to you. You convert this to from SFG, and when you sell in turn, you pay me 5% of the value of this back to me as a sale proceeds. They're not conditions which are future conditions. Now, if you see the agreement, there cannot be a future condition which cannot be established now. What the seller says, you manufacture and sell the goods. Out of the goods, what you sold, you pay me back 5% of that. So, at the time of sale, at the time of import, I don't know the future sale. Again, this condition should not be existence. So, they say that please ensure that your terms and conditions are very clear. No part or proceeds of any subsequent resale, disposal will be accrued directly or indirectly to the seller. Now they say, whatever value you are paying, in addition to that future, you have to pay me back, say 3%. You have to pay me back 10%. Don't put those kind of conditions. Buyer and seller are not related, or where buyer and seller are related, the transaction value is accepted for customs purpose under the provisions of sub-rule 3. So they're saying that when these conditions are met along with this rule A, that is, you're not imposing any conditions for usage, then I go with your transaction value. Now, sir, what if there is a related? Sub-rule 3 is talking about that. Examination, don't worry, they're not going to test these things. This is only for your academic interest. Now, I can easily jump to rule 10, I can easily jump to rule 4 from your examination point of view. But you should understand the mechanism, how it's going to work when you go back to the practical industry with this degree in your hand. For that reason, I'm making you to understand the practical issues, what you're going to have. Now, the related party comes over here, students. My related party transaction. So what if it's a related party transaction? So if there is a related party transaction, my transaction value shall be accepted, provided that the examination of circumstances, the officer is going to verify the circumstances of sale, indicated that relationship did not influence the price. So the officer has gone through your transaction, you have disclosed, sir, Priya from Singapore, Praveen from Kerala. Priya in Singapore is selling goods to Praveen in Kerala. Now, Priya and Praveen are connected together, but still, we have gone to the officer concerned to examine, to establish. So, this is the price sole consideration. Now, Priya is selling these goods not only to Praveen, she's selling these goods to, say, someone called Naveen. She's also selling these goods to someone called Namita. Now, you examine. Priya sold to Praveen, Priya sold to Naveen, Priya sold to Namita. All these three cases, identical goods, are at same stand. Now the officer says that, okay, I'll go as per your rule 3. though your related party transaction, your relationship has not influenced the price. Then rule 3 goes for acceptance. Now, there comes a problem. What is the problem? Praveen is not in a position to convince to the satisfaction of the officer that Priya and Praveen are related. There is the existence of Namita or Naveen who also purchased from Priya. Now, they say, in a sale between related persons where transaction value shall be accepted, whenever the importer demonstrates that the declared value of the goods being valued closely approximates to one of the following. So here, to prove that this value has to be accepted, I have to show identical goods. I have to show similar goods, which are to unrelated buyers. So here the condition is for the officer to satisfy himself. Praveen has to establish that whatever goods are sold by Priya are identical goods. Whatever goods are sold by Priya are similar goods. I have same value compared to the value given to Praveen. This is the challenge I have. Or I have to deduct some value. I have to do a calculation of this identical or similar goods. Now, examination, this is not tested. Practically, this is a $1 million question for establishing. So here, in simple terms, you understand that wherever a related party transaction is there, the importer or the exporter has to convince to the officer that the relation has not been disturbed the price. Now, sir, I'll go with the substitute value. Say I have imported laptop, there is a desktop. I'll go with the desktop. They say, Praveen, you have imported laptop. Please show the value for laptop. Don't compare this with a notebook. Don't compare this with a desktop. So what if I fail? If the value cannot be determined, then travel rule 4 to rule 9. They're saying that if you're failing to do so, don't worry. You go from rule 4 to rule 9 to establish how this value can be established. Let me see if there are any questions before I go further. Now, Naveen is asking this question. As per section 15, rate of duty has to be read on the date of bill of entry or date on the entry of vessel. Let's say date of bill of entry is 1st Feb and date of entry is of 10th Feb, whichever is later. Now, as per section exchange rate, rules rate of exchange has to be date on date of bill of entry. So in case of 1st Feb, okay. Naveen, I got your point, man. You're comparing with your section 15 with this exchange value. Wait for another 30 to 45 minutes. I'll clarify in detail with an example, Naveen. I absolutely got your point. For the benefit of other students, Naveen is referring to this particular problem, what we have worked out just a while ago. Computation number 2. I think, yeah. This particular problem, Naveen is comparing this with section 15, saying that, sir, as per section 15, whichever is later, I have to go as per that particular rate of duty. So section 15 talks about rate of duty, Naveen, and this particular provision talks only about the conversion rate. Just give me another 30 minutes. I'll come back to explain how do we apply the conversion rate along with the rate of duty. Just wait for 30 minutes, right? Now, rule 4. Which talks about my transaction value of identical goods. So why do I apply rule 4? Why do I apply my rule 4? Where I fail to go with rule 3. When do I fail with rule 3? There is no transaction value. When is that no transaction value exists? Example. I was giving example of this trust. A trust which imports this computer with a reading machine, reading software for the your vision impairment. The people who doesn't have vision, who are blind by birth or they have lost their sight, there's a machine which is imported. A particular manufacturer, a particular exporter gives it a free of cost to this trust in India. So assuming there are 10 machines which have landed. Now what happens? I go for rule 4. Why? In rule 3, there should be a transaction value. So there is no tax invoice. There is no commercial invoice. There is no consideration. When there is no consideration, officer has to find some alternative mechanism. Then I come for transaction value of identical goods. So what I do? What if these goods are imported by some other fellow, some other particular importer? Can I adopt that particular transaction for this particular rule 4 purpose, right? So at that point in time, we will search for rule 4. Students, we are at 8 o'clock. Let's have a break for 5 minutes. We'll reassemble back at 8:05. Continue with our discussion. So here, when I was talking about rule 4, what made me to travel from rule 3 to rule 4? So what if there is a value which is missing? My transaction value is not there. Then this provision says that, look, I'll go with the provisions of rule 3. Means, starting point, I'll take into consideration addition or subtraction of goods or services as per rule 10. Also, I'll take into consideration that there should not be any restriction of usage of those goods, right? Then I'll come to rule 4. What they say? The value of imported goods shall be transaction value of identical goods. Look at this. I go with transaction value of identical goods. How? Those sold for export to India, imported at are about the same time. So there should be a goods which are imported at or about the same time. Now, sir, is it practically possible that at the same time you have same goods in a gap, in a gap of 10-15 days? There should be some sort of goods available. Now, sir, how do I find? Google also doesn't have an answer. Don't worry. Customs officer has the knowledge of that. Once the customs officer verifies his database, he'll get to know which all consignments have been cleared of similar goods which is being valued. So what the officer will do? He will take the identical goods at the same time, at the time of importation of identical goods. Now, provided that such transaction value, whatever above is there, shall not be the value of the goods which is provisionally assessed. So what if I get a value, I get a identical goods. These identical goods are subjected to provisional assessment. What is provisional assessment? Assessment which is done on a assumptive basis, where officer gives a temporary permission under bond or guarantee. So I cannot compare my value with these identical goods which are provisionally assessed. This is what my rule 4 talks about. So here, when you have imported a Dell laptop, which is meant for a trust, they say, this Dell laptop, because sale value is missing, I compare this sale value with the identical goods. How do I do that? Pentium 4 or i5 processor, your 16 GB RAM, and whatever hard disk is there. All these features, I'll see where is the identical goods at the same time or same point in time. In doing so, they say, look, I'm giving identical goods, but please ensure that these 3 conditions are satisfied. What is that? They should have same commercial level. They should have same commercial level, but in different quantity. What is the commercial value? Sir, I have imported 10 laptops, which has got a particular price. Sir, I have imported 300 laptops, which has got some different price. Commercial level. Usage should be at some sort of comparable level. Sir, at a different commercial level, but substantially same quantity. Sir, I cannot confirm the quantity, but commercial value I can compare. Sir, I cannot compare commercial value, but the quantity can be compared. Sir, I cannot compare commercial level, I cannot compare the different quantity. Now, when I have these permutations and combinations, the government says simple. Look, there should be a comparability. You should be in a position to compare those goods for its usage. Dell laptop compared with Dell laptop. Now, one particular person has imported 10 laptop, another person has imported 300 laptop. Then you compare. This 10 cannot be compared with 300. If at all you have imported 250 laptops, let me go with that comparison. Sir, I have not imported 250 laptops. Then set aside. Sir, I have imported 10 quantity. Some other fellow also imported 12 quantity. Please do a comparison. So either do on the basis of quantity or on the basis of value, having the same usage. When I say identical goods, having the same usage. This is a basic thumb rule for your comparison purpose. Now, in doing so, if there is any adjustment required, what is the adjustment? So there is a cost of transportation. So there is a cost of this distance, loading, unloading. You are comparing with identical goods. Some goods have 50 kilometers, some goods have 150 kilometers. My manufacturer is 50 kilometers away from the port. Your comparison is 150 kilometers away from the port. So what is required? Please do the adjustment. I can seek for an adjustment. Now, this is very important. Examination. Expect one question on this identical goods in relation to this sub-rule of Rule 4. What they say, in applying this rule, if more than one transaction value of identical goods is found. So when I am comparing, I could find three prices, A, B, C with XYZ Limited. There is a trust which has imported the goods. The same goods I could find in case of XYZ Private Limited, ABC Private Limited, PQR Limited. So I have three prices. What they say, lowest of such value shall be used to determine the value. When you have more than one identical goods, whichever is lower, please adopt that. This is what my rule talks about. I'll take you through one example, students. Let me come to my Excel file in relation to Rule 4. Now, Naveen, I'll clarify your point. I got your point. You're asking with respect to change in the exchange rate. Just wait for another 15 to 20 minutes. I'll clarify that. Now, let's take this example, students. Value of identical goods. Now, Mrs. Bhakti Trust has received notebooks and stationery for free distribution in the domestic area of Maharashtra from Germany for 1,000 pieces. So what happened? They have received some notebooks and stationery. Now, you would have seen that during pandemic, a lot of goods were given at free of cost. Like a few people have given what you call this pulses, wheat, dal, or a few people have given vegetables. Few people have given clothes. Few people have given some ready to cook kind of food items. So there are few activities which have been undertaken. Similarly, in this case, notebooks and stationery were given for 1,000 pieces. Now, these 1,000 pieces were from Germany. There has been no price charged by the supplier except transportation and insurance. So what the supplier has done, look, I'm giving this particular material for free of cost. Whatever transportation insurance is there, you bear it. But for this, there is no value. Details of other imports from the same nation at the time above imports are available as below. So what happened here? That this particular 1,000 pieces, when it has come for import, I go to the proper officer. My dear officer, I have imported these goods. There is no consideration. So application of Rule 3 fails. I'll come for Rule 4. Because Rule 3 is failure, Rule 4 I'm applying. Is there identical goods? The officer says, like, these are the identical goods available. What is that? There are 4 consignments in the same point in time from Germany, where one particular party imported 800 goods, second party imported 50 goods, third party imported 1,200 goods, and fourth party imported 900 goods. Now, can I compare serial number 1 with this case? Answer is yes. Why? 800 pieces, commercial value, commercial quantity with 1,000 pieces. Rule 4, comparison. Do you remember those 3 conditions? So what I'll say? For Rule 4 purpose, 800 pieces compared with 1,000 pieces, more or less comparable, equitable, I'll say yes, can be compared. 50 quantity, can I compare with 1,000 pieces? I cannot definitely compare. So I'll ignore and I'll say I cannot compare. 1,000 pieces with 1,200 pieces. Answer is yes, I can do a comparison of identical pieces. 900 quantity, 900 pieces, can I compare with 1,000? Again, I would say yes. So here what happened? Out of 4 instances, there are 3 instances where I can apply Rule 4 for the purpose of comparison. So when I compare 12 rupee 50 paisa, 10 rupee, 11 rupee. Now out of 3 prices available, my Rule 4 clearly says that when you have more than one price for identical goods, adopt one price which is least of these three. So what I do is equal to minimum of 12 rupee or 10 rupee or 11 rupee. I have these three quantity. 10 rupee happens to be my minimum quantity. So what I'll do, 10 rupees into 1000 pieces which have been imported. This happens to be my transaction value. Transaction value happens to be 10,000. This is how I apply rule 4. Examination, just expect 2 marks on the basis of this rule 4 application. You can have a combination, 6 marks lengthy problem, 2 marks short problem. Coming back. Now, same analogy. Sir, I have rule 4, identification goods. Rule 5, similar goods. In case of similar goods, sir, I have imported Dell laptop. There is no Dell laptop. There is only Lenovo laptop available. Similar concept, what I have discussed in rule 4, entire analogy will be the same for rule 5. What they do? They pick the similar goods, do the price adjustment for the brand equity, for the distance, some sort of adjustments, and then they go for comparison in terms of commercially comparable, in terms of operability, and then when you have multiple prices, one of the price, whichever is least, will be taken for the purpose of rule 5. There's no much difference when I compare rule 5 to rule 4, similar goods with identical goods. So for the purpose of Lenovo, what I will do, the cost of the brand or functionality, some sort of adjustments I do for deriving it my transaction value. Next, rule 6. Now, as I said, rule 6 says I fail to apply rule 3, 4, 5. Rule 3 is failed, rule 4 is failed, rule 5 is also failed. Why? So there is no transaction value. So there is no identical goods. There is no similar goods. Now, when all these three are failure, I come to rule 6 and where it says, rule 6 gives me a mechanism to determine the value either under rule 7 or under rule 8. Since I'm failing, I cannot determine under 3 or 4 or 5. They say, go as per rule 7, that is deduction value, or go as per rule 8, computed value. Now, the importer can request, sir, please go with rule 7. Sir, please go with rule 8. So this kind of requisition can be made by an importer where a transaction value has been failure. Now, let's come to rule 7, deduction value. Now, what they say, sir, I go with provisions of rule 3. There is something called goods which are being sold, being valued are identical or similar, sold in India. I fail to compare, but there are identical goods which are imported or sold in India. Then what they say? If those goods are sold in India, get a declaration for the value, what is presented. This value which is being adopted for sale in India as it is in the same condition. So go with the value which is sold in India. Sir, no, these goods are not being sold as it is. These are processed for the purpose of resale. So when there is a process, you do adjustment for the process. So this rule says that you take the value. If the goods are sold as it is in India, go with that particular value. No, it is not sold as it is. If the goods are not sold as it is, then again, I have to go for getting something else called adjustment. In the process of doing this adjustment, they say you pick the value what is given by the seller. Do the adjustments on account of deductions, on account of commission, on account of cost of transportation, on account of duty paid. Why I manufacture those goods, I import in a different fashion. Do some sort of adjustments to come something called transaction value. Now, sir, I cannot find on the same date. What can I do? Wait for further period, but not beyond 90 days. Means when the goods are imported, from the date, the proper officer will wait for 90 days to see whether there are any identical goods, whether there are any similar goods, which can be compared for the purpose of this deduction. Now, practically, see, theoretically, this is good. Practically, very, very complicated to apply this particular rule. Sir, I don't have similar goods or identical goods which are available for sale in India. Then what can I do? Go with the processing cost. Adopt this generally accepted accounting principles, then do deriving. What is the cost of raw material? Add the administration and selling expenses, add the conversion cost, add your profit margin, then derive at the value. Again, examination, please keep in mind, this is not going to be tested. This is only for your academical interest. Next, computed value. Now, this is generally adopted for your related party transaction. Wherever there is a related party transaction, the conditions of sale, the price is not admitted. The officer says that I have a suspicion with respect to the price given by you. Then they resort to go for computation, calculation. So what they will do, the value will be calculated on the basis of value of material, fabrication or processing, and amount of profit, general expenses, which is generally reflected in your sale of goods for the same class or kind of goods, and cost of all expenses in relation to sub-rule Rule 10. So this particular computed value is as good as preparing a cost sheet. The officer concerned says, okay, you give me like all this value, what I'm talking to you is from exporter point of view. Exporter in a foreign non-taxable territory. So assuming I have to import goods from Germany. So what they say, that person who's there in Germany, you give the cost of raw material. Now, this 100% is not going to happen for the simple reason, the manufacturer who's there in Germany, he'll say, why should I give my cost sheet to an Indian officer? Once I give a cost sheet to the Indian officer, my trade margin gets revealed. Once the trade margins are opened up, possibility that my customers in India make a undue advantage of getting this price from a competitor. So for all practical means, they generally don't reveal this cost. So here, the rule says that you start with your cost of material of the manufacturer. Add the fabrication or processing cost. To this, add something called your general expenses. That is your selling and distribution. What is the cost incurred to sell these goods in that nation? What is the cost incurred to sell those goods to Indian importer? And the profits which generally they make. So how do I know? You compare your cost sheet. You take, like in India, we have this cost audit report. Get a cost audit report of that particular person. So practically it is not going to happen. So let this rule drop. Whatever residuary rule is there, let me go for residuary rule. So rule 9. Again, this residuary rule is as good as I write my CA final examination, leave the result to my God. Sir, I have done everything well. God, you only take care. When I'm leaving my house, I did a prayer to you. You have to take care of me. Similarly, residual method. Where I fail to adopt the value in any of the foregoing rules. In these cases, the imported goods, what they do, value shall be determined using reasonable means consistent with the principles of GAAP, generally accepted accounting provisions, on the basis of data available in India. Now, this is where I was referring to SVB, where whatever information was called for, to the extent the data is available, it will be made visible to the customs officer. But keep in mind, while doing this residual value method, principles of World Trade Organization with respect to valuation will be taken into consideration by the proper officer. So they say the value which was determined shall not exceed the price which like goods are ordinarily sold or offered for sale for delivery at the time and place of importation in the course of international trade. Now, this is a condition as per WTO. Very, very cleverly, World Trade Organization has drafted this point, saying that, look, I leave a free hand, but when you're determining the price, please look at the similar or like goods which are ordinarily sold or offered for sale, where for delivery at the time and place of importation in the course of international trade. So what they say, any goods which are exported from Germany, any goods which are exported from Japan, when you're going with this residual method, please ensure that from that originating nation, whatever export value is there, that is the cap. For an example, say related party in India, let me come to my Excel file, how this rule line works. So there is a exporter, Mrs. XYZ INC. There's an importer, Mrs. ABC Private Limited. So both are related party transactions. Now, price offer to ABC. Say it is $125 per unit. Now, it is a related party transaction. When you look into Rule 3, there was a condition that price should be the sole condition. Officer believes that there are multiple transactions. Somehow I'm not convinced with your related party transaction that there is no influence on the price. Then my World Trade Organization says that there should be a cap on loading, considering like or similar goods, how available for international trade. So, if the goods are sold to an unrelated party by exporter at say $145 or 142, they say that when you are adopting residual value method, please keep in mind this is the capping. Means this $125 you increase. The customs officer, the proper officer has a free hand to increase. But what is the capping? I can go maximum up to 142. I cannot go beyond that. So this is something which is a protection which is given from WTO. Now, why a nation like these are all policy matters when someone thinks for association. For a moment, say you happen to be a CFO. The managing director comes and says, Praveen, we are planning to acquire one company in Taiwan. This particular company has offered that this is the price. Let us know what aspects we have to check. Now, what you will do, you will see what is the operational capacity. You will see what is the potential. You will see the pricing condition. You will see the economic factors. Also see some global factors. Whether this entity or this nation, Taiwan, whether this Taiwan is a party to this World Trade Organization. Was there any trade restrictions between India and Taiwan? Was there any loading? Was there any customs customs notification saying that any goods which are imported from Taiwan, exported to Taiwan, were there any restrictions? Now, these are all few factors which have a consideration in terms of getting into trade with those organizations. Assume for a moment there is a agreement from Taiwan government with this, they are also party to this World Trade Organization. Assuming that they are a member participating in WTO, then it so happens that there is a protection by way of a residual entry to the maximum cap. So any exports from Taiwan to India, any exports from Taiwan to another nation, I can use this as a comparative price to protect the loading under customs law. So this is the advantage for me under Rule 9. Now, they say when the seller and buyer have no interest in the business of each other, under residual method, when they come, when the buyer and seller are not having any interest, not related party, then price is a sole consideration for the sale or offer. Again, this is picked up from my World Trade Organization to protect the interest of the importer. At times, it so happens that few nations, like example China, when goods are exported from India to China, now China should not impose some level of valuation mechanism to make it tough to send the goods to China. Again, WTO norms comes into protection, saying that when there is no interest, when there is no related party transaction, the price which was declared should be the sole consideration for acceptance. This is explained as per my Rule 9. Let's move on to Rule 10. Now, Rule 9 says that, look, I have given a free hand under residual method. The officer cannot blindly pick and choose the selling price of those goods produced in India. I have imported a Dell laptop. If the Dell laptop is, for a moment, Dell laptop, assuming that I have imported a particular book. If this book is manufactured in India, officer cannot blindly pick the price in India. Or if there is a system for picking alternative values for customs purpose, don't choose the highest value. Again, WTO says just because you have a comfort of comparing, don't choose a higher value. And don't choose the price of the goods from the domestic market of that country. The value which is there in domestic market, the value which is exported may vary. Now, let's come to the important Rule 10. Examination. This rule is tested for sure. Any question paper you take, students, one question will be picked up from this Rule 10 adjustments point of view. Read with. This Rule 10, read with rate of conversion, read with your section 15. Naveen has asked a question with respect to this section 15 and rate adoption. This is what examination generally questions are based from. So understand this provision. When there is an import, my Rule 10 says that there are a few costs and services which have to be added. Which have to be added for what? For the price actually paid or payable for the import of goods. So what are those? Let's go one by one to understand. The following to the extent they are incurred by the buyer. So if there is a cost which is incurred by the buyer but are not included in the price paid or payable by for the import of goods. So what happens here? Commission or brokerage except buying commission. Now this is tested for sure for 1 mark. Examination, most of the times we see that this question is tested in your examination. What they say? Any commission or brokerage which is paid in relation to import other than buying commission, please include that. So examination, they'll say, importer has paid 2% commission to the seller of, commission agent of the seller. So if there is a commission paid, Other than buying commission, please add to the transaction value. Examination, they'll clearly mention commission paid by the importer for the purchase, that is in relation to buying. So then exclude that commission. Cost of container, which are treated as being one of the customs purpose. Cost of container. Container is like your, it is not a packing material. It is essential for me to carry that material. Example, if you happen to see this sewing thread. Now, the sewing thread, when you see a thread does not come on its own. The thread should be rolled on a roller. I have a roller. So when I sell this sewing thread for 5 rupees, the component cost of 5 rupees includes the roller. So this roller is like a material. It is, I can return back. They say, look, the manufacturer has purchased the container for the purpose of selling raw material. So the cost of that container should also be considered for valuation. And cost of packing, because packing is essential, that should also be included. If not included, these are the 3 additions for the commissioner brokerage. Okay, this I think we have discussed. Examination, again, 1 mark from this particular slide. Value, apportion or appropriate. For what? Goods and services supplied directly or indirectly, buyer free of charge or at a reduced cost. For what? Use in connection with the production or sale of export of imported goods, to the extent such value has not been included. Now, manufacturer, importer. This importer has given some goods to manufacture. How? At a free of charge or at a reduced cost. For what? For a production or manufacture or sale of those goods to India. So what could be those transactions? Like raw material, component, parts or similar items incorporated in the import goods. Now this, most of the time, these cases we see in related party transaction. My raw material is exported to Taiwan for converting as a semi-finished goods. Again, it will come back to India. My raw material goes to China for converting as a semi-finished. Again, it comes back to India. Tools, dyes, molds, and tools, dye, mold, jig, or similar items used in production. Material consumed in the production of the imported goods. Engineering, development, design work, etc. Now, these are few additions where there is a apportionment or concession rate. So what they say? Amortization cost. Your cost of these goods, if not included, please amortize those costs for the purpose of your valuation. Now, a simple question to you. Sir, how does the proper officer, the customs officer, know that this transaction took place? Now, when you read this as a theory, you would have understood. So you say that simply that this material should be added back. Is there a way a proper officer can really look into these transactions? Answer is a big yes. Where is the possibility? Balance sheet, notes to accounts. My balance sheet, notes to accounts, it reveals all related party transactions. What goods have sent to my related party? Sir, let me change this transaction. You're saying that in my financial statements, my notes to accounts gives this data. What if I do this way? Praveen is in India. Say Priya is in Singapore. Praveen and Priya are related party. Let me do this way. I'll bring a third party called Naveen. Praveen sells some goods to Naveen. Naveen in turn sends to Priya. How do you find out this transaction? Please remember, there is something called GR waiver letter. Goods, when I export without a consideration, I go to a bank, I inform to my banker that, my dear banker, I'm sending these goods on a free of consignment basis. I'm not going to get a consideration. Please give me a GR waiver certificate. This GR waiver certificate, I give it to customs authorities. for the RBI purpose, for FEMA regulation, I get a GR waiver, I give this declaration. Unless this certificate is there, customs authorities will not permit to export. Now, this is a history which is created on customs portal. That customs portal, what happens? The material which is going to Naveen, from Naveen, again, they look at the transactions of Naveen. Naveen is going to send some material to Priya. Now, this is how the route is established. This is the reason the other day I was telling, getting into customs, getting into this administration is absolutely not that easy. And the people who are there as a proper officer under customs, they are the masters in looking into this transaction. And for this, they get trained a lot, and they are the best of the best officers who work in the revenue administration. Moving further. So what else I have to do? Now, royalty license fee. Royalty and license fee, which is related to imported goods, buyer is required to pay. Now, sir, you are saying that I import the raw material. Where is the question of royalty? Now, most of these companies you would have seen foreign technical know-how, royalty, license fee, fee for foreign technical services. Many ways money go out of India. That is actually nothing but in relation to these goods. To save customs duty, they adopt these routes. For that reason, they say, look, you're paying a royalty or license fee in relation to those goods. Please add back to transaction value. This needs to be added back to transaction value. Sir, I pay, no, this is paid directly or indirectly, or as a condition of sale of goods being valued to the extent that such royalty and fee are not included in the price actually paid or payable. Sir, I do a process, I do a manufacture. Then what I have to do? Though you do a process of manufacture, because there is a dependency on these imported goods, include that royalty to my transaction value. This is where my related party transaction comes into picture. The value of any part of proceeds or subsequent resale, if there is any money paid back to the seller on a subsequent sale, now this is practically not that easy to find. So this can be ignored. Now, third party sale. Any payment made to a third party, like I gave an example. Naveen has imported goods from Priya, but Naveen has made the payment to Namita. There is a third party transaction. So that third party transaction should also be included as per this particular clause. What else? Sir, you have said many things. What else? Rule 10 says that, look, in addition to all those, cost of transportation, loading, unloading, handling associated with the delivery of the imported goods to the place of importation. So, why we are taking CAF? Why we are not taking FOB? For the purpose of customs, please always keep in mind, I don't take FOB. I take CAF. Why? My rule 10 clearly says cost of transport, loading, unloading, handling charges associated with the delivery of the imported goods to the place of importation. Also, my cost of insurance. So freight has been covered in this point. A, my insurance is covered in this particular point, cost of insurance. Now, so what if my cost referred to in clause A, that is transportation, not ascertainable? Then such cost shall be 20% of the FOB. So they say that in case if there is a transportation which is not available, this is nothing but 20% of FOB. So once I know the FOB value, on that 20% happens to be my transportation cost. So what if I don't know my insurance? It is 1.125% of the FOB value. Now, this one slide is going to test it for 2 marks in your examination. I'm telling you, students, your examination questions are based on one compulsory question from valuation, where this slide alone is tested for 2 marks. Where My transportation is not given. So if transportation is not given, 20%. Sir, insurance is not given, 1.125% of FOB. This is the mechanism how my calculation is done for this particular FOB value. So what if, in case the goods are imported by air, cost referred to transportation is not there, then they say that it shall not exceed 20% of FOB value. So in case of goods imported by air, there is a cap. The cost in relation to transport shall not exceed 20% of the FOB value. Again, this is tested for 1 mark. Which point? This. Please keep in mind, only by air. If it is by sea, there is no capping. If the transportation is by air, my transport cost shall not exceed 20% of FOB value. This is your point number 1. Next, point number 2. So in case goods are imported by sea or air or transshipped to another customs station in India, the cost of insurance, transport, loading, etc. associated with the transshipment shall be excluded. What is transshipment? Transshipment is a mechanism where goods are moved from one location to another location for purpose of your what you call non-availability of the permission. So the goods have entered Vizag. There is no some climatical conditions. These goods are not permitted to get unloaded in Vizag. So from Vizag, I go to the nearest port called say Tuticorin port. So it's called transshipment. I move the goods from Vizag to Tuticorin for the reason there is a conditional permission which is not given. So they say by sea or air, if the goods are transshipped to another customs station in India, cost of insurance, transport, loading, unloading, hand loading associated with transshipment shall be excluded. So I don't add those costs. Now, this we have discussed boat charges. The cost of transport of imported goods shall include ship demurrage charges or chartered vessel, lighter or barge charges. Now, this is what we have discussed. When there is a ship which is coming into India, it cannot enter into territorial waters, or it is a chartered vessel. There is a demurrage charges. Why? You are holding the chartered vessel for sake of value. I'll give this example. Sir, I have imported the material on 15th. There was some news that the government of India is going to come with a notification where there is an exemption going to happen. So I purposefully hold that vessel in territorial waters, waiting for the government notification to come. Once the government notification comes, the entry will happen immediately. Now, those cases, they say any demurrage charges or any lighterage or barge is paid, you consider that for the purpose of your value under Rule 10. Now, let's look at few examples on the basis of this Rule 10. Naveen, your point gets clarified here, ma? Now, from the given information, calculate from the given information, compute the customs duty and IGST payable. So they've asked us to compute what is IGST payable from and also customs duty. So here what they have given, value of goods on CAF basis, $5,600. The currency is in foreign currency. My CAF value is $5,600. Insurance paid $180. Freight charges incurred till place of importation $1,300. Now, look at these three information, students. CAF is there, insurance is there, freight is there. From these three, what is that I can calculate? CAF is there, insurance is there, freight is there. Applying these three, what is that I can calculate? What is that I can calculate? Be quick enough. There are a few questions. Namita, Another 10 minutes, I'll finish this example and I'll clarify all your doubts. Now, you have seen CAF, you have seen insurance, you have freight. Now, applying, now when I solve these three, what is the value I can derive? What is the calculation I can derive from these three values? Apply your thought process and let me know. Looking at these three, what is that you can find out? I couldn't see any answer. Now, Priya says COGS. Perfect. This is it is equation connected with the COGS. Opening stock plus purchases minus closing stock. I get your COGS. Similarly, CAF minus insurance minus freight. What do I get? FOB. Right? So when I look into these three information, CAF is there, insurance is there, freight is there. So from CAF, I remove insurance, I remove freight, I left with my FOB. This is the importance point. Okay. Next. Cost of design paid by the importer is included in CAF value. So here, your CAF value is $5,600, which includes a cost of design for $450. Now the question comes here. This cost of design, applying Rule 10, should be retained in 5,600, should not be retained. To be included, not to be included. Please give your answer, students. My 5,600 should include 450 or should not include 450. What would be your answer? What would be your answer? Yes, Naveen. Naveen gives the answer FOB for the previous question. Now, this $450 student, should I include in $5,600 that is cost of goods, or shall I exclude? What does my Rule 10 say? Jairam says yes to include. Good. So here, applying my Rule 10, since 5,600 includes 450, I'll not do any adjustment. That has to be considered as per Rule 10. To be included as per Rule 10. Now, they have given some information. What is that? Date of arrival of aircraft, 15th June. Date of filing of bill of entry, 30th June. Rate of duty on arrival, 12%. Rate of duty on date of filing of bill of entry is 18%. Right? This is the information given. So look at this carefully, students. What I will do here, let me come on to the right hand side. For convenience, I'm just shifting these slides, this particular note here. Now, FOB of transaction. I'll mention value in dollar, value in INR. Now, FOB transaction 5,600 minus insurance 180 minus freight 1,300. I get something called FOB. So what we know in case of FOB transaction through air, they have given the information that this is through air. So if the transaction is through air, I can have my freight charges 20% of FOB. Now, $4,120 into 20%, I get 824. But actually, what was the amount included? Freight incurred 1,300. So as per your Rule 10, what they say, in case of imported goods, by air, where the cost referred to in clause A is ascertainable, it shall not cost is ascertainable. Such cost shall not exceed 20% of FOB. So there is a capping under Rule 10. My freight cost is to be capped to 10%. Now, so why is done like this? This is a policy decision of the WTO. So what they do? Though my freight is 1,300, I'll consider only 824 as my freight. Insurance, I add back this 180 rupees. CIF as per Rule 10. Now, this is my CIF. Now, question comes here, Naveen. Naveen is asking a question. Sir, here, my date of arrival on that day, 78 rupee per dollar. On the date of filing of bill of entry, $76. What shall I do? My provisions under Customs Act says that for the purpose of calculating your INR conversion rate as per Rule 46, as per Section 46, when I file my bill of entry, that will be the conversion rate. So here, bill of entry has been filed on 30th June. On that day, 76 rupees per dollar. So what I will do here, 524 into 76. This happens to be my INR. Now, are we clear till now? I have imported this material on the day when bill of entry has been filed. That day I'll take my conversion rate. I'll not go with the date of arrival. 76 happens to be my conversion rate. Now, rate of duty. Now, next question. So what will I do with this cost of design? This cost of design, should I add to 5124? Need not, because this 5600 includes 450. We have not done any adjustment over here. Now, value for customs under Section 14 is 3,89,424. On that, basic customs duty as per Section 15, read with Customs Tariff Act. Now, if you remember Section 15, students, I have two dates. Date of arrival 15th June, filing of bill of entry 30th June. As per Section 15, I have to adopt a rate whichever is later. So my customs duty shall be the rate on filing of bill of entry. So here, instead of 12%, I'll take 18%. That is 18%. Now, so my customs duty will be on 3,89,000. I'll apply 18%. This is my customs duty. Now, Naveen asked a question. Sir, you have adopted 76 rupees, but the rate you have considered is 18%. Okay. In this case, both happen to be 76 and 18%. Now, Naveen is asking, sir, what will you do with this gap of 2 rupees, 76 and 78? That 76, 78 has no relevance, Naveen, because for the proper officer, what is the INR? For taking INR, the day I file my bill of entry under Section 46, that is important. So here, I'll just blindly take 76, Naveen. I will ignore that 2 rupees, which is into consideration. Now, and on this basic customs duty, social welfare surcharge applicable at the rate of 10% as per Finance Act 2018. So what I will do, on 70,000, I apply 10% social welfare surcharge. Now, value for IGST, Section 3, subsection 7, 8 of Customs Act. So what I'm doing, I'm calculating for IGST under section 3, subsection 8. My value, that is transaction value, plus customs duty, plus social welfare surcharge. Assuming IGST of 18%, what I will do? On this 4,66,000, 18% happens to be my IGST. Now, examination. This is the model which is frequently tested in many of your attempts. This is a model. This is a model frequently tested in many of your examination. Right? Okay. Next. Namita is asking, so design cost to be included. This is a tricky point, Namita. I was saying this design cost of design paid by the importer included in CAF. So this CAF, when we started, Namita, 5,600 is including 450. So that 5,600, what we have done when we started our problem, from 5,600, I just included, I have excluded insurance, I have excluded freight. I have not excluded $450. So this value of $420 includes 450. That reason, I will not add back again that $450, Namita. Naveen is asking this question, sir, what if arrival date is 30th June, bill of entry is 15th June? Okay. Bill of entry, arrival. Naveen, in this case, what we will do, since the bill of entry is filed on 15th June. Now, since bill of entry is filed on 15th June, this foreign currency 5124, whatever is there, instead of 76, I'll add up 78, Naveen. If I file my bill of entry on 15th June, my conversion rate instead of 76, it happens to be 78. This is a conversion rate. So what will I do with the rate? Section 15. As per section 15, because arrival happens to be a later point, my customs duty happens to be 18%. That doesn't get affected, Naveen. Hope this is clear, Naveen. Now we are at 9:02. I'll take another 5 minutes, students, because there are a few more questions. Let me answer those questions. Namita is asking this question. Sir, in 10 tons converted to semi-finished goods, as per rule 3.2, 5% of subsequent value sale is paid back to the seller. So it is not valid. How do we establish that subsequent sale is a question mark, Namita? If that subsequent sale is clearly evident, I'll go as per rule 3.2. If it is not evident, I'll travel till rule 10 to see how that value can be determined. And even rule 10 says, Namita, to add back that 5% to the rule 3 transaction. Next, Namita is asking this question. Mr. A got prohibited goods from John as gift. Will rule 7 will apply? It will not apply, Namita. Prohibited goods, I'll not go as per similar or okay. If it is given as a gift, now prohibited goods, now you cannot compare and you cannot permit itself. Next, Namita is asking this question. In rule 10, price of goods sold in India is not taken, but in rule 7, price at which goods sold in India is taken. This is for deduction purpose, Namita. What I'm doing, I'm just taking that value. From that, I'm removing. I'm not blindly taking that value. See, my rule 10 says that you take that value and do additions. In rule 7, when I say deduction value, that rule, I'll take that value which is sold in India, I'll remove the few adjustments to derive something called my transaction value. In GR waiver example, Naveen is located. Where is Naveen located? Naveen could be located in the same place where Priya is located. Now, customs officer will say, look, Praveen has exported goods to Naveen. Naveen in turn gave those goods to Priya. For what? For this mold for manufacture purpose. So this is how a tri-party transaction is established. If cost of design is by Indian, then it in that case also it to be considered. Santosh, if this cost of design is relevant for the manufacturer, then yes, ma'am, we have to take that into consideration. Last but not the least, let's come to the value of exports. Now, exports is very simple and straightforward case where they say, look, in case of exports, whatever method of valuation, what value was given, that will be considered as transaction value. Until and unless if there is the price is not the sole consideration. As long as price is not the sole consideration, I go with your transport value. So what if price is not sole consideration? Then I go with comparison. What they will do, they'll compare your price with the price prevailing with a parallel, identical or similar goods. So I'll take that identical or similar goods at the same point in time. If it is acceptable, I'll go with that. So if that price is not available, then they go with the computation. So what they do, whoever is the exporter in India is there, they take what is your raw material cost, what is your processing cost, what is your markup, what is your administrative expenses, overheads. All this they will take into consideration for the purpose of doing the calculation. Sir, if this data is not to be adopted because there is a dependency on some other part which is imported, then residual method. Finally, they'll go with the declaration by the exporter saying that whatever price, whatever information was given are all true and fair, not to have any intention to do fraud or suppression. And finally, what the officer concerned has got a right to reject the value which is given by the exporter concerned. So with this, we come to the end of our discussion on the export of value. Examination, please go through this particular chapter for the simple reason you have 6 marks, 4 to 6 marks definitely tested for sure in this particular chapter. So we'll meet back again on the next week. Till then, good night, goodbye. Is it?